Welcome, my friends. Um, I am recording this predominantly for a friend of mine who is starting her new business shortly. And we were talking about the importance of knowing um, how accounting works, because as the owner, you need to know what your financial situation is at all times. Nowadays, we all use computerized accounting systems that do 99% of the work for us. But at the end of the day, it is up to us, the proprietors of that business, to understand those understand that financial information and make sense out of it. So, um, double-sided bookkeeping has been the standard for accountings for decades, for almost centuries. And it is an elusive thing. Many people just cannot wrap their head about understanding it. In my past, I used to design, build, and sell financial accounting systems. And I met in my time selling the accounting software, accountants, CPAs, even auditors, who really did not fully understand how the double-sided accounting entry system works. That doesn't say it's difficult. It says it's elusive. And if it's explained properly, which I have been doing for uh, come to close to 40 years now, 45 years now, um, it is quite understandable. It is quite easy. So the key to it is this cross that you see in front of you that splits the page into four sides, because there are four types of accounts, and we're going to start to record them. So on the left-hand side, we need to record our income. So when we receive money from things that we count as income, we need to record that. And income, by definition, is a credit. It makes sense. A credit is usually associated with positive. A debit is usually associated with negative. So um, the double-sided accounting system works on recording every transaction twice, one as a credit and once as a debit, and finding the right places to put them. We will go through that. The second types of account we need to have is expenditure, the money we spend as a company, our rent, our salaries, bills that we get, and all of that. We need to keep track of that as well. So we record that in the lower left-hand side, and we will call that expenditure. We also have an account called assets. Assets are different than income. Income is money you make. Assets, um, income is money you make from sales. Assets is things that the company owns. It owns its own building. It owns its bank account. It owns its copyright. It owns cars. It owns equipment. These are assets that belong to the company. And also, if the company owns things, the company will have also liabilities. It owes other people money. It buys things on credit. Then the creditors are people who you have liabilities towards. At this point, it's important to remind my friends of the following. A big mistake usually made is that people do not understand that the company has its own entity. The company is not an extension of its owner. The company has its own accounts separate from its owners. And that will become very clear when we make the first transaction. So you and I started this company. We're going to buy some raw materials. We're going to manufacture something, some fancy widgets, and we're going to sell them. So we dip in our pocket and we come up with $5,000 and we put it in the bank. So a bank is an asset. So we're going to record $5,000 as a debit transaction, and we're going to put it in the bank. Now remember what we said. A double-sided accounting means there has to be another side. So where would the other side go? Well, think about it. Now the company owes its owner $5,000. The owner have lent the company $5,000. Remember, the owner and the company are separate entities. So we will record a liability against the company that is $5,000 that belongs to the owner. So here we have one debit transaction, one credit transaction. They are equal. We are hunky-dory. We're doing well. So we started doing some business. So the first thing we did is we spent money by buying some raw materials. Except the company that gave us the raw materials were happy to give it to us on credit, give us 30 days to pay. So we're going to record that we have incurred an expenditure of $1,000. But guess what? We also need to record the other side of it. So what happened? What happened was that we have now, transaction number 2, we have now a liability on the company worth $1,000 that belongs to that supplier that eventually we have to pay. So transaction number 2 is $1,000 debit as expenditure and $1,000 credit in my liabilities. They're equal, they're opposite sides, everything is good. Then we started doing some work and we manufactured some of that raw material, and it cost us $2,000. Okay, it cost us $2,000. Whatever cost we went through to actually make something we can sell. So now we spent $2,000 in cash to get these products done. So I record that as an expenditure. Where does the other side of it goes? It goes, transaction number 3, it goes under my assets because I have now spent $2,000 out of my bank. I'm recording it as a credit. I'm showing it here as a negative in red just to help you understand. Usually we do not record it as a negative transaction. We only record it as a credit. But it will help what I'm doing here, so bear with me. So now we have some manufactured product. Next step is we sold some. So our 4th transaction was we managed to sell $7,000 worth of goods, okay? And we sold it to a customer who is going to pay for it in 60 days. So we sold it on credit. We did not get the cash, but we have sold the products. So I record the sale. It's an income. I haven't realized it, but it's an income. And where does the other side go? Well, the other side goes as an asset because that is money I am going to receive eventually when my customer pays. So it goes on my asset side and I record it. So it was a credit here, 7,000. It's a debit here, 7,000. They're equal. They're opposite sides. Everything is good. By this time, we hit the first end of month and we have to report our account. So what do we have? So let's just assume this is where we got after 1 month or first quarter. First thing I do is I add all my income. So 7,000. I add all my expenditure. 1,000 plus 2 is 3,000. I add all my assets, and this is why I put the this one in red so you can see how the calculation works. So I have $10,000 worth of assets. 5 minus 2 plus 7 is 10. And then I add all my liabilities, and I get $6,000 worth of liabilities. And now I have generated the company's accounts. Are we 100% done? Have we done everything? Well, almost. So let's take it to the next step. If you subtract your expenditure from your income and you come up with a positive number, you have made a profit. In our case, we have. We have income worth of 7,000 and expenditure worth of 3,000. So we have made a profit worth $4,000. If you spent more money than what you made, well, guess what? You've just made a loss. Happens to all of us. And now we're done. So what happens next? Well, let's start where we left off. This is how our accounts looked like. You would hear the following words, the following names of reports in accounting all the time. You hear about the balance sheet, you hear about the profit and loss accounts, profit and loss sheet, you hear about the general ledger, the sales ledger, the purchase ledger. What are those things? Well, I'm going to tackle 3 of them for you right now. If you take the left-hand side of this page, which is the income and the expenditure, this, my dear friends, is your profit and loss statement. It's your income all listed, it's your expenditure all listed, and there is a one line, it's a calculated line. Remember, look at it, the profit here does not have a transaction number, and it doesn't have an other side of a transaction. It's just a calculated number, and that now you have produced for your accountants and for your tax people. You have produced your profit and loss statement. That's all there is to it. Big companies, profit and loss look exactly like this, except it's probably 1,000 times more sophisticated. But at the basic level, this is what it is. And if we look at the right-hand side, the list of our assets and our liabilities, if you put those together in one report, they will produce your balance sheet statement. All right? That's all there is. A balance sheet is a list of all your liabilities and all your assets, and it's a balance sheet. So what does profit and loss report tell you? Well, from its name, it tells you how profitable your company is. Okay. What does the balance sheet tell you? The balance sheet tells you is how valuable your company is. Let's look at a major company like Google. Okay. If you only look at Google's profit and loss alone, you will see that on trillions of transactions, they're making very little profit. So you go, oh, you know, Amazon is not a good company to invest in. They make very little profit, right? Well, that will be incomplete information, because if you looked at their balance sheet, you would see that the company is incredibly valuable. It's valued at, if I remember, over $1 trillion. Okay, that is a massive value. So there's a lot of value in the company. The company has a lot. Their cash reserves is ridiculous. Their assets are ridiculous. So you need both reports to understand the health of your company. Profit and loss tells you you're moving in the right direction, you're making profit, your expenditure are under control, your sales are doing well. Your balance sheet tells you how valuable your company is. Okay, if you are to sell that company tomorrow, what it would be valued at. And according to this, your company is worth $10,000 today. Okay, remember, you started with 5,000, now your company is worth 10,000. All right, there's a problem. One of you will look at me and says, it's called balance sheet, but it's not balanced. Where's the balance in balance sheet? Well, that is true. It's not yet balanced, but we are going to balance it. How do we balance it? We balance it with the great equalizer. What is the great equalizer? Remember this thing called profit, the calculated number? It's not an actual transaction. When we are generating our reports, this is what we do. We take that number as a number, not as a transaction, and we move it to the profit and loss, and we will record it there as a number, not as a transaction, worth $4,000 profit that we made. So why is it in the liabilities? Because that money belongs to who? That money belongs eventually to the owners. So it's a liability on the company to its owners. So the owners are in the positive, but the company is in the negative. So by doing that, what have we achieved? We have achieved now that our total liabilities are 10,000, our total assets are 10,000, and bang, we have a balanced balance sheet. The company's balance sheet is balanced at all times. Okay, and it's balanced every time you generate the report, because every time you generate the report, the software that you use will take your profit and or loss and move it over and record on it to make your balance sheet balanced. I hope this have given you a quick introduction on the double-sided accounting, on what our profit and loss accounts are, what balance sheet accounts are, and I'm just going to do one more, okay? Because it's like the easiest thing is. People talk about the general ledger this, the general ledger that. What is the general ledger? Well, let's take a look. Take all your accounts, all your transactions. You notice I have all my transactions, 1, 2, 3, 4, and they're all recorded in the debits and credits. You list them in whichever order the accountant wants and put a label on it. It's their general ledger. That's all the general ledger is. What is it made of? It's made of your income accounts, expenditure accounts, assets accounts, liabilities accounts, all your accounts. You list all your accounts, bingo, you got a general ledger. Okay. We are done with the 3 major reports, your profit and loss, balance sheet, and general ledger. I'm just going to talk to you about something small, which is your bank. So let's just make one more transaction. It's a good practice. You managed to sell another $2,000 of manufactured goods for $2,000 worth of cash. So we record an income of $2,000. Now we have to took that cash, put it in the bank. So we're going to put $2,000 in the bank, and we label it as from the sales of manufactured goods. Now, if you take a look at transaction number 1, 3, and 5 in the assets column, this is, my friends, is your bank statement. So when the bank sends you your bank statement and you want to reconcile it, you come to this side of your accounts, and your bank statement should have 3 accounts. You open up an account with 5,000. You spend $2,000 worth of cash on manufacturing activities, and then you took $2,000 worth of cash in terms of additional sales. Okay. So your bank is not the only asset you have. If you look down here, transaction number 4 is still an asset that you have, but it's not money in the bank yet. That customer hasn't paid you yet. I hope this is helpful. If you have questions, please post them here on this channel, and I will do my best to answer them for you. And in the next episode, I will talk to you about what the sales ledger is and what the purchase ledger is, and how they relate to these things here. All they are, they're not new transactions. They are transactions that are grouped to be presented here in an easy way. I hope you have a good time. Stay safe, stay healthy, and I see you in the next lecture. Take care.